Andrew, are you a short-term bull in any asset?
So good. It's good to be here with you. So we are. I mean, we do think that the S&P 500 and other risk markets in the short term can trade higher. You know, this is the view of my colleague Michael Wilson, Morgan Stanley's CIO and chief equity strategist. And I think he had a well-timed call last Monday that the S&P could trade up towards 4,100. Some of the more tactical indicators that we follow are showing a favorable kind of oversold condition and some healing of key metrics. So, look, in the short term, we think we can get some relief. The fact that earnings season is also been relatively strong is also helpful. But big picture, I don't think this changes it. We still view this as a bear market rally rather than the start of a larger new bull market move.
Right. So if we're oversold and undervalued, but we're still in the throes of a deep, long bear market, where would we likely see the value traps?
Well, I do think a market like China is challenging. It's a market that is very inexpensive on a lot of the valuation measures that we and other investors follow. But, I think clearly has major macroeconomic uncertainties, and that valuation rubric has been, unhelpful so far this year. It's been an inexpensive market all year and continued to be so. I also think that investors face a lot more trade-offs in terms of where relative valuation is. If I go back to the S&P 500, a market where tactically we're constructive, you still face this bigger picture challenge where the earnings yield on the S&P is about the same as the yield on 1 to 5 year corporate bonds, which is unusually narrow. And so that kind of limits the ability of the PE to re-rate higher. Meanwhile, we think the earnings estimates, maybe they're fine for this quarter, but we think they'll move lower over subsequent quarters. And so all of that does cap some of that upside. So again, I think you face, a variety of challenges to this market, the tactical picture being a little bit better, but big picture, these moves in bonds are capping how much valuations we think can improve in some of these markets.